There is a ghost in the machine of the stock market. It's the phantom of past glory, the lingering echo of a time when a company was king. This ghost seduces investors. It whispers tales of unassailable dominance, of a brand that was once on the lips of every American, of a technology that once defined an era. And so, the average investor, the diligent retail investor looking for a safe harbor for their capital, buys a piece of this ghost. They buy a name they recognize, a fortress they remember from their childhood. They buy a company like Eastman Kodak, Sears, or Pan Am. They purchase a stock certificate that is, in reality, a ticket to a slow and painful financial decline. They mistake a memory for a moat. This is perhaps the most dangerous and costly error in the entire field of long-term investing. It's the trap that separates the amateur from the master, the gambler from the wealth builder. The master, the architect of true financial freedom, understands a principle so fundamental yet so often ignored that it acts as a permanent dividing line between mediocrity and extraordinary returns. The principle is this: it is not enough to simply see that a company has a competitive advantage, a moat. The only question that matters, the one that unlocks decades of portfolio growth, is whether that moat is getting wider or narrower with each passing day. Warren Buffett, the man who built a $100 billion empire from this very principle, didn't stumble upon this wisdom by accident. He learned it through victory, but more importantly, he learned it through the stinging pain of multi-billion-dollar mistakes. He learned that the stock market is not a museum of corporate artifacts to be admired. It is a dynamic, brutal, and unforgiving battlefield. On this battlefield, the fortresses of yesterday are the ruins of tomorrow. And the only way to win, the only reliable investment strategy for building wealth, is to become a student of the future, not a historian of the past. You must train your mind to see not just the castle, but the direction of the current in the moat. Is the water level rising, making the walls taller and the fortress more imposing? Or is a new, unseen technology, a subtle shift in consumer behavior, silently draining the water away, leaving the walls vulnerable for any competitor to scale? Answering this question correctly is the secret. It's the key to avoiding the value traps that litter the stock market for beginners and experts alike. It is the definitive skill that will allow you to construct a portfolio not of ghosts, but of giants. The enduring, untouchable businesses that will dominate the next decade and beyond. This is not just another stock-picking tip. It is a complete rewiring of your financial brain. It is the final promise of value investing. The first and most critical chapter in this mental rewiring is understanding the great deception of the static moat. It's the illusion that a competitive advantage is a permanent feature, a label you can apply to a company like its stock ticker and then forget about. The 99% of investors who fail to beat the market fall for this illusion every single time. They perform their stock analysis by looking in the rearview mirror. They see a company that has dominated its industry for 50 years and assume it will dominate for the next 50. They see a brand that is a household name and believe that familiarity equals invincibility. This is a catastrophic error in judgment, a failure of imagination rooted in a deep-seated psychological bias. True investment research is not about cataloging past successes. It is about stress-testing a business against the relentless pressures of the future. Warren Buffett learned this lesson in the most painful way imaginable, not with a small speculative bet, but with a massive capital allocation that became one of his most cited failures. The story isn't one of complex derivatives or high-flying tech. It's a story about shoes. Simple, well-made American shoes. The story of Dexter Shoe Company. In 1993, Berkshire Hathaway was a corporate titan, and Warren Buffett was already a living legend. He had a track record that defied logic, built on buying wonderful businesses at fair prices. He looked for companies with deep, durable moats, and in Dexter Shoe, he believed he had found another one. Based in Maine, Dexter was the quintessential American success story. It produced sturdy, comfortable shoes, it was profitable, it had a brand that resonated with a loyal customer base, And perhaps most importantly, it was a domestic manufacturer, seemingly insulated from the complexities of global trade. To Buffett, Dexter looked like a castle. It had a brand moat, a reputation for quality, and a long history of profitability. He was so confident in its enduring strength that he didn't just buy a piece of it, he bought the entire company. And in a move that would become legendary for its poor outcome, he didn't use cash. He used Berkshire Hathaway stock, a currency he considered almost sacred. He paid $433 million, which at the time represented a significant portion of Berkshire's book value, all in Berkshire shares. He wasn't just investing, he was making the Dexter Shoe shareholders partners in his grand enterprise. He believed their moat was so wide and so stable that their future earnings would more than justify the price. He was tragically wrong. What Buffett saw as a sturdy stone fortress was, in reality, a sandcastle standing at the edge of a rising tide. The moat he had identified was not static, it was rapidly, fatally narrowing. The force draining that moat was globalization, specifically the relentless rise of low-cost foreign manufacturers. While Dexter was paying fair American wages to its workers in Maine, competitors in Asia and South America were making comparable shoes for a fraction of the cost. The brand loyalty and reputation for quality that Buffett had prized so highly were not enough to overcome the massive price differential. Consumers, when faced with a choice between a $30 American-made shoe and a $10 foreign-made equivalent of similar quality, began to vote with their wallets. The competitive advantage that had been built over decades was being systematically dismantled, not by a single rival, but by an irreversible global economic shift. Dexter's pricing power evaporated, its margins collapsed, its sales dwindled. The castle was being overrun, and Buffett, the master investor, was trapped inside. Years later, he would call the Dexter Shoe acquisition the worst deal he had ever made. The $433 million in Berkshire stock he used to buy the company would, in the following decades, become worth billions, and then tens of billions. He hadn't just lost the initial investment. Dexter eventually went to zero. He had lost all the future compounding of the Berkshire shares he had traded away. It was a mistake of astronomical proportions, a permanent loss of capital that served as an eternal reminder of the core thesis. A moat that is narrowing is not a moat at all. It is a trap. The psychological principle at the heart of this colossal mistake is something behavioral scientists call status quo bias. It is our innate, deeply ingrained preference for the current state of affairs. Our brains are wired to assume that the future will look very much like the present, and the present looks like the recent past. This is an evolutionary shortcut. For most of human history, assuming that the watering hole that was safe yesterday would be safe today was a good survival strategy. But in the world of business and investing, which is characterized by constant, disruptive change, this bias is a wealth-destroying cognitive error. When the average retail investor looks at a blue-chip stock, a company that has been a pillar of the economy for generations, their brain defaults to the status quo. They think, this company has always been here, so it will always be here. They see the long history of dividend payments, the familiar logo, the massive headquarters, and these things anchor their perception of stability. They are looking at a snapshot, a single frame in a very long movie, and assuming the rest of the film will be identical. This is precisely the trap Buffett fell into with Dexter Shoe. He saw a long history of American manufacturing dominance, a brand that had endured, and his mind extrapolated that stability into the future. He underestimated the power of the disruptive force, globalized, low-cost labor, because it represented a change to the status quo he had grown accustomed to. This bias is amplified by another powerful psychological force, nostalgia. We have positive emotional associations with the brands we grew up with. We remember our first pair of Nike sneakers, our first Coca-Cola, our first Apple computer. These memories create a warm, fuzzy feeling, an emotional moat that can blind us to cold, hard business realities. An investor who loved their local newspaper for decades, who relied on it for news and community connection, might find it emotionally difficult to accept that the internet is rendering its business model obsolete. Their nostalgia for the past clouds their analysis of the future. They anchor to the memory of the wide moat, unable to see the digital tide that has already washed it away. For a disciplined approach to long-term investing, you must actively fight this bias. You must become a ruthless pragmatist, divorcing your emotional attachments from your capital allocation decisions. The market does not care about your memories. It does not reward nostalgia. It only rewards an accurate assessment of future cash flows. Status quo bias convinces you that the moat is a permanent fixture. Your job as a serious investor, committed to building wealth, is to constantly challenge that assumption, to actively search for evidence that the world is changing and that the moat is, in fact, disappearing before your very eyes. So how do we translate this awareness into a concrete, repeatable process? We need an applied mental model, a blueprint for analysis that forces us to look forward instead of backward. Let's call it the trajectory test. This is a simple, three-step process designed to shift your perspective from a static snapshot to a dynamic analysis of a company's competitive advantage. Step 1 is to explicitly define the moat. Don't just say it's a great brand. Be specific. Is it a network effect, like Facebook, where the value increases with each new user? Is it high switching costs, like the bank that holds your mortgage and checking account, making it a pain to leave? Is it a low-cost production advantage, like Geico's direct-to-consumer model? Is it an intangible asset, like the secret formula for Coca-Cola, or the patents protecting a pharmaceutical drug? You must write down, in a single sentence, the specific source of the company's power. For Dexter's shoe, Buffett would have written, "Dexter's moat comes from its brand reputation for quality American-made shoes at a reasonable price." Being this specific is the crucial first step. Step 2 of the trajectory test is to brainstorm the assassins. You must actively and pessimistically list every potential threat to that specific moat you just defined. This is not the time for optimism. This is a pre-mortem. Imagine it's 10 years from now, and the company has failed. What killed it? For the Dexter shoe sentence, the list of assassins would be: Number 1, a significant increase in the cost of American labor. Number 2, a major shift in trade policy that makes imports cheaper. Number 3, the emergence of foreign competitors who can produce a good enough product for a fraction of the price. Number 4, a change in consumer preference where Made in America is no longer a major selling point. This part of the exercise forces you to abandon the status quo bias and actively engage with the forces of change. Your goal is to be paranoid on behalf of your capital. Step 3 is the final and most important part of the trajectory test. Search for evidence of trajectory. For each of the assassins you listed, you must now become a detective and look for real-world evidence that they are either growing stronger or weaker. This is where diligent investment research separates the pros from the amateurs. In the early 1990s, when Buffett bought Dexter, was there evidence that low-cost foreign manufacturing was a growing threat? Absolutely. The rise of manufacturing in Asia was already a well-documented trend. Were trade barriers being lowered? Yes, the groundwork for NAFTA and other trade agreements was being laid. An investor applying this test would have been forced to confront these uncomfortable facts. They would have had to conclude that the forces working against Dexter's moat were not just theoretical, they were real, they were powerful, and they were accelerating. The trajectory of the moat was undeniably narrowing. This three-step process, define, brainstorm assassins, and find evidence of trajectory, is a powerful antidote to the static moat illusion. It forces a forward-looking perspective, transforming your stock analysis from a passive observation of the past into an active investigation of the future. Now let's explore the antithesis, the path of the 99% of investors who fall victim to this illusion. Their journey begins with a feeling, not an analysis. They operate on what feels safe, what feels familiar. The archetypal investor on this path is the nostalgia buyer. This person walks through a mall, sees a store like Sears or JCPenney, and remembers shopping there with their parents. They remember the brand being a titan of retail. That memory, that warm, nostalgic glow, is their primary buy signal. They open their brokerage account and buy the stock, feeling a sense of comfort and safety. They tell themselves, Sears has been around for over 100 years. It's a survivor. It's a safe blue-chip stock. They have just mistaken a historical fact for a forward-looking investment thesis. They have bought the ghost. What they fail to do is apply any form of the trajectory test. They don't specifically define the moat. What was Sears' moat? In its heyday, it was its powerful catalog business, a distribution advantage, and its trusted house brands like Kenmore and Craftsman, an intangible asset. Next, the nostalgia buyer completely fails to brainstorm the assassins. They are so blinded by the past glory that they ignore the existential threats staring them in the face. What were the assassins for Sears? First and foremost, the rise of more efficient big-box retailers like Walmart and Target, which destroyed Sears' cost structure. Second, the explosion of e-commerce, led by Amazon, which made its catalog and vast physical store footprint an expensive liability rather than an asset. Third, the decline of the American mall, which starved its stores of foot traffic. Fourth, years of incompetent management that failed to invest in stores and technology, allowing the brand's reputation for quality to erode. These weren't subtle, hidden threats. They were front-page news for years, yet the nostalgia buyer ignored them. They saw the stock price falling and thought, it's cheap, it's a value stock. They didn't realize they weren't buying value. They were catching a falling knife. They were buying a business whose competitive advantages were not just narrowing but being annihilated. The consequences are financially devastating. The stock chart of Sears is a brutal, uninterrupted slide to zero. Every dollar the nostalgia buyer invested was a dollar incinerated. This is the fate that awaits those who invest by looking in the rearview mirror. They become owners of crumbling fortresses, holding onto worthless shares while the world moves on, all because they fell in love with a memory. The direct financial connection between a narrowing moat and an investor's portfolio is both direct and devastating. It manifests as a slow, grinding destruction of value. Let's trace the financial decay of a company like Dexter Shoe. In the beginning, when the moat is wide, the company enjoys high returns on invested capital, ROIC. For every dollar they invest in a new factory or new shoe designs, they generate, say, 20 cents in annual profit. This is the sign of a healthy, dominant business. But as the low-cost foreign competition, the assassin, enters the market, the first thing to crack is pricing power. To compete, Dexter has to lower its prices or offer discounts. This directly impacts the income statement. Gross margins, the profit on each pair of shoes sold, begin to shrink. A company that once had 50% gross margins might now have 40%, then 30%. This means less profit is available to cover operating expenses, research, and marketing. As margins shrink, profitability declines. The high ROIC that was the hallmark of the business begins to fade. Now, for every new dollar invested, the company might only generate 5 cents of profit, or maybe even less. At this point, growth becomes destructive. If a company is investing capital at returns below its cost of capital, every dollar it reinvests in the business is actually destroying shareholder value. The balance sheet starts to show signs of stress. Inventory might pile up as shoes become harder to sell. The company might have to take on debt to fund operations. On the cash flow statement, you'll see operating cash flow stagnate and then decline. The river of cash that once flowed from the business slows to a trickle. For the stock market investor, this financial decay is initially masked by the company's reputation. The stock price might hold up for a while due to the status quo bias of the market, but eventually reality always wins. The company will start missing earnings estimates. Analysts will downgrade the stock. The dividend, once considered sacred, might be cut or eliminated. This is when the stock price begins its long, painful journey downwards. The capital gains you hoped for become permanent capital losses. This is how a narrowing moat financially translates into portfolio destruction. It's not a sudden collapse. It's a terminal illness, a slow erosion of financial health that guarantees the investment will end in failure. Recognizing the trajectory of the moat is therefore the ultimate act of financial self-defense. If the narrowing moat is a trap, the widening moat is the holy grail of long-term investing. It's the engine of compounding, the creator of dynastic wealth. A company whose competitive advantage is actively growing stronger over time is not just a good investment, it's a force of nature. It becomes an ever larger castle, its walls growing thicker, its moat growing deeper and more treacherous for any would-be competitor. These are the businesses that generate the kind of portfolio growth that leads to true financial freedom. Identifying these dynamic fortresses requires a different kind of stock analysis, one focused on the sources of increasing strength. These sources are often subtle but immensely powerful, growing network effects, rising switching costs, and expanding brand power. The story of Warren Buffett's single greatest investment, made in the crucible of a national panic, is the ultimate masterclass in identifying a moat that was not just wide, but rapidly widening. It's the story of American Express and the Great Salad Oil Scandal. In late 1963, the financial world was rocked by a scandal of epic proportions. A small, seemingly insignificant company in New Jersey called Allied Crude Vegetable Oil, run by a man named Tino DeAngelis, had perpetrated a massive fraud. DeAngelis had borrowed hundreds of millions of dollars using his inventory of salad oil as collateral. The problem was, the inventory didn't exist. His massive storage tanks, which were supposed to be filled with valuable oil, were mostly filled with water, with only a thin layer of oil floating on top to fool inspectors. American Express, through a subsidiary, had been the primary issuer of warehouse receipts guaranteeing this collateral. When the fraud was exposed and Allied Crude went bankrupt, Wall Street panicked. The consensus was that American Express was on the hook for all the fraudulent receipts, a liability so large it could bankrupt the entire company. The stock price was annihilated, plummeting nearly 50% in a matter of weeks. The herd was selling, convinced that the American Express castle was about to be washed away in a flood of litigation and fraud losses. This was the path of the 99%. But Warren Buffett, then a young, relatively unknown fund manager in Omaha, saw something different. He didn't focus on the scandal. He focused on the moat. He understood that American Express had two core businesses, its traveler's checks and its charge card. He believed the competitive advantage of these businesses was not just intact, but was likely to widen as a result of the crisis. He decided to do his own on-the-ground investment research, a classic Buffett maneuver. He didn't just read financial reports. He went out into the real world to measure the moat himself. He visited restaurants and travel agencies. He talked to merchants and customers. He would go to a restaurant, pay with an American Express card, and observe the cashier's reaction. Did they hesitate? Did they question the card's validity? Then he would try to pay with a rival card and see the difference. He did the same with traveler's checks, going to banks and asking if they would still honor them. What he found was extraordinary. Despite the screaming headlines about fraud and potential bankruptcy, the behavior of real people, the customers and merchants who use the American Express products every day, hadn't changed at all. The brand, the intangible asset at the core of the company, was so powerful that it was completely unshaken by the scandal in its warehousing division. People still trusted the little green card. They still relied on the traveler's checks. The moat was holding. In fact, Buffett reasoned the moat was widening. The American Express card operated on a powerful two-sided network effect. The more customers who held the card, the more essential it was for merchants to accept it. And the more merchants who accepted it, the more valuable the card became to its holders. This creates a virtuous cycle, a feedback loop of ever-increasing strength. At the same time, the traveler's check business had an enormous float-based advantage. People would give American Express their cash and in return get checks they might not use for weeks or months. In the meantime, American Express could invest that cash, the float, for its own profit. Buffett saw that the fear and panic on Wall Street were focused on a temporary, solvable problem in a non-core part of the business, while completely ignoring the indestructible, growing power of the core franchise. He concluded that the market's reaction was irrational, so he acted decisively. He invested 40% of his partnership's capital, a massive career-defining bet, into American Express stock. Over the next few years, as the company settled the salad oil claims for far less than feared and the power of its core business reasserted itself, the stock price soared. The investment was a grand slam, generating enormous capital gains and helping to lay the foundation for the Berkshire Hathaway empire. It was a victory born from looking past the short-term noise and focusing on the long-term trajectory of the competitive advantage. The underlying psychological principle that explains both the market's folly and Buffett's genius in the American Express case is what his partner Charlie Munger calls the Lollapalooza effect. This is the tendency for multiple cognitive biases or powerful forces to act in the same direction, leading to an extreme, often irrational outcome. In 1963, Wall Street was in the grip of a negative Lollapalooza. First, you had herd bias. As a few influential investors started selling Amex, others followed suit, creating a cascade of panic selling without any independent analysis. Second, there was availability bias. The story of the fraud was dramatic, memorable, and widely reported. This vivid, easily available information dominated investors' thinking, causing them to overweight the importance of the scandal and underweight the less exciting but far more important data about the strength of the core business. Third, there was a failure of what psychologists call domain specificity. Investors incorrectly assumed that a problem in one division, warehousing, automatically meant the entire company was rotten. They couldn't compartmentalize the issue. These forces all converged to create a perfect storm of negativity, driving the stock to absurdly low levels. Buffett, by contrast, was able to harness a positive Lollapalooza effect in his own thinking. He wasn't just analyzing one source of strength. He was looking at how multiple sources combined to create an unbreakable fortress. He saw the network effects of the charge card. He saw the power of the brand as an intangible asset. He saw the high switching costs for loyal customers and merchants who were deeply integrated into the Amex ecosystem. He saw the financial advantage of the float from the traveler's checks. Each of these was a powerful moat widener on its own. But together, they created a compounding effect, a Lollapalooza of competitive advantage that made the business far stronger than the sum of its parts. His investment strategy was to find businesses where multiple powerful, positive forces were all pushing in the same direction. This is the essence of identifying a widening moat. You aren't looking for a single trick. You're looking for a confluence of factors that create a self-reinforcing system of dominance. The retail investor who can train their mind to look for these positive Lollapalooza effects will be playing a different game, a game geared towards finding the true long-term compounders that can transform a portfolio. To systematically find these dynamic powerhouses, we need a mental model, a practical blueprint. Let's call it the Moat Widener Checklist. This is a series of questions you must ask about a business to determine if its competitive advantage is actively expanding. This is the core of effective investment research for beating the market. Question 1. Is the network growing stronger? For a business with network effects, like a social media platform, a credit card company, or a software ecosystem, you must look for evidence of increasing engagement and user growth. Is the value proposition for the next user joining the network greater than it was for the previous user? For American Express, the answer was a clear yes. Every new cardholder made the network slightly more valuable for all merchants, and every new merchant made it slightly more valuable for all cardholders. That's a widening moat. Question 2. Are switching costs rising? Think about your bank, your cell phone provider, or the accounting software your business uses. How difficult, costly, or annoying would it be to switch to a competitor? A company that is actively making it harder for customers to leave is widening its moat. This can be done by integrating more services, creating loyalty programs, or becoming deeply embedded in a customer's workflow. For example, as a business uses more features of a software suite like Microsoft Office, migrating all of its data, retraining employees, and ensuring compatibility with a new system becomes a monumental task. The switching costs are actively rising, locking the customer in and giving the company immense pricing power. Question 3. Is the brand gaining power? A powerful brand allows a company to charge a premium for a product that is often functionally identical to its competitors. You must ask, is the company's brand commanding more pricing power today than it did 5 years ago? Can it raise prices without losing significant market share? Look at a company like Apple. The brand is so powerful that it can sell an iPhone for a significant premium over a technologically comparable Android phone. And with each successful product launch, with each new shot on iPhone marketing campaign, that brand power, that intangible asset grows stronger. The moat widens. Question 4. Is there a growing low-cost advantage? Some companies, like Costco or Geico, win by being the undisputed low-cost provider in their industry. Their moat widens as they gain scale. With every new store or new policyholder, their fixed costs are spread over a larger base, allowing them to lower their prices even further, which attracts more customers, which gives them more scale. It's another virtuous cycle. You must analyze if the company's cost advantage over its rivals is increasing or decreasing over time. By systematically going through this checklist, network effects, switching costs, brand power, and cost advantages, you can move beyond a vague sense that a company is good and develop a concrete, evidence-based thesis for why its moat is actively widening, positioning your asset allocation for superior long-term results. The antithesis to this disciplined approach is the path taken by the 99%, the path of the short-term earnings chaser. This investor is completely obsessed with the next quarterly earnings report. Their entire stock analysis process revolves around predicting whether a company will beat or miss analysts' expectations by a penny. They are playing a short-term guessing game, not a long-term game of business analysis. This investor would have looked at American Express in 1963 and seen only one thing: a massive, uncertain liability that was going to destroy the next few quarters of earnings. They would have sold immediately, congratulating themselves for avoiding the bad news. They completely miss the bigger picture. They are so focused on the individual trees, the quarterly earnings per share, that they fail to see the magnificent growing forest of the underlying business franchise. The short-term earnings chaser often makes a critical error. They punish companies for making smart, long-term investments that widen their moats. For example, a company might decide to spend heavily on research and development to create a new product that will dominate the market in 5 years. This spending will depress earnings in the short term. The earnings chaser sees the lower earnings and sells the stock, screaming about, quote, inefficient management. In reality, the management team is doing exactly what it should be doing, sacrificing a little short-term profit to build a much wider, more durable long-term moat. Amazon is the classic example. For decades, Wall Street analysts and short-term investors complained that the company wasn't profitable enough. They fixated on the quarterly numbers. They failed to understand that Jeff Bezos was strategically reinvesting every dollar of profit back into the business, into logistics, into Amazon Web Services, into new product categories, to build one of the widest and most formidable moats in business history. The investors who followed the short-term earnings chaser path sold Amazon for a small profit or even a loss in the early 2000s. The investors who used the moat widener checklist understood what was happening and held on, participating in one of the greatest wealth creation stories of all time. The lesson is clear: focusing on short-term earnings is a loser's game. True portfolio growth comes from identifying businesses that are methodically and intelligently widening their competitive advantage, even if it causes some short-term financial pain. The financial connection between a widening moat and your portfolio is where the magic of compounding truly happens. It creates a powerful self-reinforcing engine for capital gains. Let's trace the financial life of a company with a widening moat, like one with growing network effects and brand power. In the early stages, the company can grow revenue rapidly by acquiring new customers. Because of its competitive advantage, it can do this while maintaining high gross margins. Unlike the company with the narrowing moat, it doesn't need to constantly discount its products to win business. This combination of top-line growth and high margins leads to an explosion in operating cash flow. The business becomes a veritable cash machine. Now comes the crucial part that separates the great from the good: what the company does with that cash. Because its moat is wide and growing, it has a plethora of high-return opportunities to reinvest that capital. It can invest in more research and development to strengthen its products, increasing switching costs. It can spend on marketing to further enhance its brand, increasing its pricing power. It can expand into new markets, leveraging its existing advantages. Each of these investments generates a very high return on invested capital, ROIC. When a company can consistently reinvest its profits at high rates of return, it creates a powerful compounding effect. The profits from year 1 are reinvested to generate even bigger profits in year 2, which are then reinvested to create astronomical profits in year 10. This is the financial engine that drove companies like Microsoft, Google, and yes, Berkshire Hathaway itself. As an investor, this shows up on the financial statements as a beautiful trinity: rising revenues, stable or increasing margins, and a consistently high ROIC. Over time, the intrinsic value of the business grows exponentially. The stock price will inevitably follow this growth in intrinsic value. This isn't about timing the market or guessing quarterly earnings. It's about hitching your financial wagon to a business that is getting fundamentally stronger, more dominant, and more profitable with each passing year. That is the ultimate investment strategy for building lasting wealth. While identifying a widening moat is the path to prosperity, it is equally, if not more, crucial to master the art of identifying a moat under attack. Fortunes are not just made in the stock market, they are preserved. And the greatest threat to your capital is the silent, often invisible, erosion of a company's competitive advantage. These silent moat killers, disruptive technology, shifting consumer tastes, and value-destroying management, can turn a blue-chip champion into a penny stock faster than most investors think possible. Warren Buffett, despite his reputation as a technophobe, is not afraid of technology itself. He is terrified of its power to destroy the moats of established businesses. His reluctance to invest in many technology companies for years was not a Luddite's protest. It was the calculated caution of a man who understood that the pace of change in that sector meant that moats could be built and destroyed in a matter of months, not decades. However, his most famous mistake in this area was not in failing to buy a tech winner, but in buying a non-tech business whose moat was about to be obliterated by a force he underestimated. This was the true lesson of Dexter Shoe. It wasn't just about foreign labor. It was a story about the relentless and unforgiving nature of competitive erosion. Let's revisit the Dexter Shoe acquisition through the specific lens of identifying threats. The foundational anecdote here isn't just the purchase in 1993, but the years that followed. After the deal closed, Buffett watched with a growing sense of horror as the business he had bought with his precious Berkshire stock began to unravel. The primary threat, as we know, was low-cost foreign competition. But it's vital to understand why this threat was so lethal and why Buffett, the master of moat analysis, missed it. He fell prey to what we can call intangible asset overconfidence. He placed too much faith in the power of the Dexter brand and the Made in America label. He believed these intangible assets were strong enough to justify a premium price and insulate the company from cheaper rivals. He underestimated the raw, brutal power of price in a commodity-like product category. Shoes, for the most part, are not a product with high switching costs or network effects. A customer can try a new brand with very little risk or friction. When a competitor came along offering a functionally similar product for a third of the price, the brand loyalty Buffett had paid so dearly for proved to be shockingly fragile. The second silent killer at play was a slow, subtle shift in consumer behavior. The buyers who had valued the durability and American heritage of Dexter shoes were an aging demographic. Younger generations were more influenced by fashion trends, marketing, and most importantly, price. Companies like Nike were building their moats not on manufacturing excellence, but on a completely different intangible asset: marketing and brand association with superstar athletes. They had outsourced the low-margin manufacturing to the very same low-cost foreign factories that were destroying Dexter, while they focused on the high-margin work of brand creation. Buffett, a man of simple tastes who famously wears comfortable, inexpensive shoes, may have had a personal blind spot to the power of fashion and marketing in that specific industry. He analyzed Dexter as a manufacturing business when the shoe industry was transforming into a brand and marketing business. This is a critical lesson for every retail investor. The basis of competition within an industry can change. A moat built on one factor, like manufacturing, can be rendered obsolete when the key to success shifts to another factor, like marketing. Dexter shoe became a monument to this principle, a multi-billion-dollar lesson in the importance of identifying and respecting the silent killers that threaten even the most seemingly secure competitive advantages. The psychological principle that allows these moat killers to operate undetected is known as normalcy bias. This is our cognitive tendency to underestimate the probability of a disaster or a major disruption. We assume that things will continue to function in the future the way they have in the past. It's why people build houses in floodplains or fail to prepare for earthquakes. In the world of investing, normalcy bias is a portfolio's worst enemy. An investor holding stock in a dominant retailer for 20 years develops a deep-seated belief that this dominance is the normal state of affairs. When a new disruptive competitor like Amazon appears, their first instinct is to dismiss it. People will always want to go to a physical store, they tell themselves. This online thing is a niche. They are clinging to their established perception of normal. They filter out evidence that contradicts their worldview and seek out information that confirms it, a related bias known as confirmation bias. They might focus on a news story about Amazon's lack of profits while ignoring the data on its exponential revenue growth. This is what happened to countless investors in companies like Blockbuster. For them, the normal way to watch a movie was to drive to a store, browse the aisles, and rent a physical cassette or DVD. The idea of a company called Netflix mailing DVDs, let alone streaming content over the internet, seemed absurd and inconvenient. It was a deviation from the norm. Their normalcy bias prevented them from seeing that Netflix wasn't just a different company, it was a fundamentally superior business model that would make Blockbuster's entire infrastructure of thousands of high-rent retail stores a crippling liability. They held on to their Blockbuster stock, reassured by its familiar presence on every street corner, all the way to bankruptcy. To succeed in long-term investing and achieve portfolio growth, you must declare war on normalcy bias. You must constantly ask yourself, what disruptive force, what change in technology or consumer behavior could make the normal state of this industry completely obsolete? You have to force yourself to imagine the unimaginable, because in the landscape of modern capitalism, the unimaginable happens with startling regularity. To systematize this paranoia into a productive tool, we can use a powerful mental model called the pre-mortem analysis. This technique, popularized by psychologist Gary Klein, is the inverse of a typical post-mortem. Instead of waiting for a project, or in our case, an investment, to fail, and then asking what went wrong, you assume from the very beginning that it has already failed. This is a core component of any rigorous investment strategy. Here's how you apply it to a stock analysis. Step 1. Imagine it's 10 years in the future, and the company you're considering investing in has gone bankrupt. The stock is worthless. It has been a complete and utter disaster for your portfolio. Step 2. On a blank piece of paper, write the history of that failure. What happened? What specific forces killed the company's moat and drove it into the ground? Don't be vague. Create a detailed, plausible narrative. Was it a new technology that made its product obsolete? Was it a low-cost competitor that started a price war it couldn't win? Did a key patent expire? Did a change in government regulation cripple its business model? Did a series of terrible acquisitions by an incompetent CEO drain its resources? Let's run a pre-mortem on a hypothetical dominant company, say a traditional cable television provider in the year 2010. The company looks invincible. It has a monopoly in most of its markets, generates massive recurring cash flow, and pays a healthy dividend. The normalcy bias investor would buy this stock and sleep soundly. But the pre-mortem analyst imagines it's 2020 and the stock is down 80%. What is the story of its collapse? The narrative might go like this. The rise of high-speed internet enabled new streaming services like Netflix, Hulu, and later Disney Plus to offer a compelling alternative. Consumers, tired of paying for bloated cable bundles filled with channels they didn't watch, began to cut the cord in droves. At first it was a trickle, but it soon became a flood. The cable company's most profitable customers, the ones who subscribed to premium packages, were the first to leave. This destroyed the company's pricing power and margins. At the same time, content producers like Disney and HBO started pulling their best shows and movies to use on their own streaming services, devaluing the cable bundle even further. The company was trapped, facing declining subscribers and rising content costs. It was a classic death spiral. By conducting this exercise, you force yourself to see the threats not as distant possibilities, but as concrete events. It transforms you from a passive cheerleader for your stocks into an active and skeptical risk manager, which is essential for preserving capital and building wealth over the long term. The antithesis of the pre-mortem analyst is a very common character in today's market, the hype-driven innovator. This investor is obsessed with the new and the novel. They chase narratives, not numbers. They are drawn to companies that promise to disrupt everything, often without a clear understanding of what makes a business durable. They mistake a cool product for a wide moat. A perfect example would be the investors who piled into meal kit delivery companies like Blue Apron when they first went public. The story was compelling, fresh ingredients and recipes delivered to your door, disrupting the grocery and restaurant industries. The hype was immense. The hype-driven innovator saw the sleek branding and the celebrity endorsements and was sold. They bought into the IPO dreaming of owning the next Amazon. What they failed to do was any serious analysis of the moat, let alone a pre-mortem. If they had, they would have immediately identified the fatal flaw in the business model, the almost complete lack of a competitive advantage. What was stopping anyone from doing the same thing? There were no network effects. There were no high switching costs. In fact, customers could cancel with a single click. There was no proprietary technology or low-cost advantage. The industry was a bloodbath of competition, with dozens of look-alike companies all spending a fortune on marketing to acquire the same customers, who would then churn after a few weeks to try a rival service, offering a better introductory discount. The moat wasn't just narrowing. It never existed in the first place. The story of Blue Apron's stock is a painful lesson in the difference between a good idea and a good business. The stock price collapsed by over 99% from its IPO price, incinerating the capital of the hype-driven innovators who had been seduced by the narrative. They learned the hard way that the most dangerous thing in investing is a great story attached to a terrible business. The disciplined for entrepreneurs investor knows that innovation is only valuable when it is protected by a deep, widening moat that prevents competitors from capturing all the profits. The direct financial connection between a company's moat and its vulnerability to these silent killers is starkly visible in its financial statements over time. A company facing a mortal threat will see its financial health deteriorate in a predictable pattern. Let's use the example of a traditional brick-and-mortar retailer being disrupted by e-commerce. The first sign of trouble often appears on the top line of the income statement. Revenue growth stagnates or even turns negative. Fewer customers are coming into the stores. At the same time, to compete with online rivals, the company is forced to run constant promotions and sales. This is the erosion of pricing power, and it shows up as declining gross margins. So now you have a toxic combination: flat or falling sales, and lower profit on each sale you do make. This pressure then flows down the income statement. The company still has to pay rent on its thousands of stores, pay its employees, and maintain its infrastructure. These are its operating expenses. With less gross profit to cover these fixed costs, operating margins get crushed. The company that was once highly profitable is now barely breaking even, or worse, losing money. On the balance sheet, you'll see inventory levels swell as goods sit on shelves unsold. To fund its losses and try to reinvent itself, the company might start taking on debt, leading to a weaker financial position. On the cash flow statement, the once mighty river of cash from operations dries up. The company might start burning cash, meaning its basic operations are consuming more money than they generate. This is the financial death spiral. For an investor, watching this unfold is brutal. The market will eventually recognize the terminal decline. The stock price will fall, dividends will be cut, and the prospect of capital gains will be replaced by the certainty of capital loss. Understanding how to spot these patterns of financial decay is not just good stock analysis. It's a survival skill for any retail investor who wants to avoid the graveyards of the stock market and achieve long-term financial freedom. We've established the critical importance of assessing the trajectory of a moat, but this analysis can't remain purely qualitative. To be truly effective, we must move from the conceptual to the concrete. We need to quantify the current, to develop a dashboard of key metrics that can tell us, with objective data, whether a company's competitive advantage is truly widening or dangerously narrowing. Narrative is powerful, but numbers don't lie. A great story about a company's dominance is meaningless if the financial data tells a tale of decay. Warren Buffett, for all his folksy wisdom and focus on simple business principles, is a master of financial statement analysis. He knows precisely which numbers reveal the health and strength of a company's moat. The quintessential example of this quantitative approach is his beloved investment in See's Candies. In 1972, Buffett and his partner Charlie Munger, through their company Blue Chip Stamps, acquired See's Candies for $25 million. On the surface, it didn't look like a typical Buffett investment. It was a regional chocolate company with modest growth prospects. Many on Wall Street would have dismissed it as a boring, slow-growing business. But Buffett saw something else. He saw a business with a phenomenal, albeit intangible, competitive advantage, an incredibly powerful brand that commanded fierce customer loyalty and, most importantly, significant pricing power. See's Candies had a special place in the hearts and minds of its customers on the West Coast. It was the go-to gift for holidays, birthdays, and special occasions. The box of See's chocolates was as much a part of the gift as the contents inside. This deep emotional connection was the company's moat. But Buffett didn't just rely on this qualitative assessment. He looked at the numbers to prove his thesis. He saw in See's financial history a remarkable pattern. Every year, the company could raise its prices by a small amount, say 5 or 10%, to cover rising costs of sugar, chocolate, and labor, and its customers wouldn't flinch. The volume of pounds of candy sold would remain steady, or even grow slightly. This was the quantitative proof of the moat. This pricing power was a magic wand that created immense value. The small, consistent price increases flowed almost entirely to the bottom line, generating huge amounts of cash relative to the capital invested in the business. The company required very little capital to operate, just some stores and basic candy-making equipment. It didn't need massive R&D spending or constant factory upgrades. As a result, it produced exceptional returns on invested capital. Buffett calculated that the $25 million purchase price would soon be returned to him in just a few years of after-tax earnings, and the business would still be there, a cash-gushing machine that he would own for free. Over the decades, See's Candies has generated over $2 billion in pre-tax earnings for Berkshire Hathaway, all while requiring minimal additional capital investment. It became Buffett's prototype for the perfect business, a company with a durable, widening moat that could be measured through its consistent pricing power and extraordinary returns on capital. The psychological principle that makes this quantitative analysis so important is the need to overcome the availability heuristic. This is a mental shortcut where our brains rely on immediate examples that come to mind when evaluating a topic or decision. We give undue weight to information that is recent, dramatic, or easy to recall. In investing, the most available information is often the company's story or narrative. We hear about Apple's innovative products, Tesla's visionary CEO, or Coca-Cola's global brand recognition. These stories are powerful and easy to understand, so they dominate our thinking. We fall in love with the narrative. The numbers, buried in a dense annual report, are less available. They require effort to find and interpret. The availability heuristic causes the average retail investor to make decisions based almost entirely on the story, while neglecting the underlying financial reality. The story of a company might be that it is a, quote, fast-growing tech leader, but the numbers might show that its revenue growth is being achieved by burning through mountains of cash with no clear path to profitability. The story might be of a stable, blue-chip dividend stock, but the numbers might show a steadily declining return on equity and a dangerously high dividend payout ratio, suggesting the dividend is unsustainable. By forcing ourselves to focus on the quantitative metrics, we are counteracting the seductive pull of the availability heuristic. We are making the less available but more important information the centerpiece of our stock-picking process. A disciplined approach to value investing requires that you trust the numbers even when they contradict a compelling story. The numbers tell you the objective truth about the moat's trajectory. See's Candies had a nice story, but it was the incredible numbers, the consistent pricing power, the high margins, the low capital requirements that proved the story was real and durable. Financial education for beating the market is largely about learning which numbers matter and how to let them guide your decisions, insulating you from the emotionally charged narratives that so often lead investors astray. To apply this quantitative rigor to your own investment research, you need a mental model, a moat dashboard. This is a small set of key financial metrics that you will track for a company over a long period, ideally 10 years or more. The trend in these numbers will give you a clear, objective signal about the direction of the moat. Metric 1 on your dashboard is gross margin percentage. This is calculated as revenue cost of goods sold / revenue. It tells you how much profit a company makes on each dollar of sales before accounting for operating expenses. A company with a strong competitive advantage, like pricing power or a cost advantage, should have high and stable, or ideally, rising gross margins. If you see a company's gross margins consistently declining over several years, it is a massive red flag. It's a quantitative sign that their moat is narrowing and their pricing power is eroding. Metric 2 is return on invested capital, or ROIC. This is the single most important long-term metric for assessing a business. It measures how much profit a company generates for every dollar of capital that has been invested in it. A high and sustained ROIC, say above 15%, is the hallmark of a great business with a wide moat. It proves that management can reinvest profits effectively to generate even more profit. A company whose ROIC is consistently declining is a sign of a deteriorating competitive position. A company whose ROIC is below its cost of capital, typically around 8 to 10%, is actively destroying value with every dollar it reinvests. Your goal is to find businesses that are gushing cash at high rates of return on capital. Metric 3 is sales general and administrative (SG&A) expenses as a percentage of revenue. This metric reveals a company's operating efficiency. A company with a widening moat often exhibits increasing scale advantages, meaning this percentage should be stable or, ideally, decreasing over time. If you see SG&A expenses growing faster than revenue for a prolonged period, it can be a sign that the company has to spend more and more on marketing and sales just to stand still, another indicator of a narrowing moat. By creating this simple dashboard, tracking gross margins, ROIC, and SG&A trends over a decade, you move beyond guesswork. You create a data-driven system for assessing moat trajectory, a powerful tool for any retail investor serious about building wealth through superior stock selection. The antithesis to this data-driven approach is the path of the 99%, embodied by the gut-feeling gambler. This individual treats the stock market like a casino. Their investment decisions are based on whims, hot tips, and vague feelings about a company or an industry. They might buy a stock because they like the product, or because their brother-in-law said it was going to the moon. They conduct zero quantitative analysis. They have never read an annual report. They couldn't tell you the difference between gross margin and operating margin. Their entire process is subjective and emotional. For this type of investor, stock analysis is a foreign concept. They are not investing, they are speculating. The gut-feeling gambler is particularly susceptible to narratives. They might hear about the promise of blockchain technology and immediately buy a dozen different cryptocurrency-related stocks without understanding any of their business models or financial situations. They are buying the story, the hype. They see a stock price moving up quickly and are gripped by FOMO, the fear of missing out. They pile in at the top, just as the early smart money is selling. When the bubble inevitably pops, they are left holding the bag, nursing huge losses. They then blame the rigged market for their misfortune, never once acknowledging that their failure was a direct result of their complete lack of a disciplined quantitative process. They drift from one hot stock to the next, constantly chasing the next big thing, and slowly but surely bleed their capital away. The gut-feeling gambler's portfolio is a chaotic collection of story stocks and speculative bets, with no underlying logic or strategy. It is the polar opposite of a carefully curated portfolio of businesses with demonstrably wide and widening moats, backed by a decade of strong and improving financial metrics. The path to financial freedom is paved with disciplined analysis, not impulsive gut feelings. The direct financial connection between these quantitative metrics and your portfolio growth is the essence of value creation. Let's make this crystal clear. A company with a consistently high ROIC, say 20%, is a value-creating machine. If that company retains half of its earnings and reinvests them back into the business, its intrinsic value can be expected to grow by about 10% per year. 20% ROIC asterisk 50% retention rate. This is the engine of compounding. A business that can grow its intrinsic value at 10% per year will, over the long run, deliver a stock market return of roughly 10% per year. The stock price must eventually follow the underlying value of the business. Now contrast this with a company with a low ROIC of 5%. If this company retains half of its earnings, its intrinsic value will only grow by 2.5% per year. The long-term returns from owning this stock will be dismal, likely failing to even keep up with inflation. Furthermore, trends in these metrics are predictive. A company whose gross margins are expanding from 30% to 40% over 5 years is demonstrating increasing pricing power. This increased profitability will flow directly to the bottom line, increasing earnings per share. Higher earnings justify a higher stock price, leading to capital gains for the investor. Conversely, a company with declining margins is on a path to lower earnings and a lower stock price. By focusing your capital allocation on businesses with the quantitative signatures of a widening moat, high and stable ROIC, rising margins, and operational efficiency, you are systematically tilting the odds of success dramatically in your favor. You are ensuring that your portfolio is filled not with speculative gambles or deteriorating businesses, but with elite, value-creating enterprises. This is how you move from being a market participant to a market beater. It is the most reliable investment strategy for achieving significant long-term portfolio growth. We have now arrived at the fifth and final pillar, the ultimate litmus test for the trajectory of a competitive advantage. It is not enough for a company to have a wide and widening moat that generates enormous amounts of cash. The final critical question is, what does management do with that cash? A brilliant business can be ruined by a foolish management team that squanders its resources. Conversely, a good business can be transformed into an extraordinary investment by a management team that allocates capital with skill and discipline. This is the capital allocation test. It is the ultimate proof of a widening moat. because a truly intelligent management team will use the fruits of its existing moat to dig it even wider, to make the castle even more impregnable. The history of Berkshire Hathaway is filled with examples, but none is more illustrative of this principle than Warren Buffett's involvement with the Washington Post Company and its legendary leader, Katharine Graham. In the early 1970s, the Washington Post Company was primarily known for its flagship newspaper, a dominant franchise in a major city, a classic moat. The paper was a cash-generating machine. However, the newspaper industry itself was facing headwinds and had limited opportunities for high-return reinvestment. A typical, less imaginative management team might have taken the excess cash from the newspaper and reinvested it back into the newspaper business at mediocre returns, or worse, squandered it on unrelated, empire-building acquisitions in glamorous but unprofitable sectors. This is the path of diversification that destroys so much shareholder value. But Katharine Graham was not a typical manager. And starting in 1973, she had a new board member and major shareholder to guide her capital allocation decisions, Warren Buffett. Buffett bought a significant stake in the Post because he saw not just a great asset in the newspaper, but a leader in K. Graham who was rational, honest, and willing to think like an owner. Together, they executed a masterclass in capital allocation. They recognized that the cash generated by the newspaper moat was best deployed outside of the newspaper business. Instead of pouring money into a low-return industry, Graham, with Buffett's guidance, used the cash to make a series of brilliant, value-accretive decisions. They bought back huge amounts of the company's own stock when it was trading at a significant discount to its intrinsic value. Every share they repurchased made the remaining shares more valuable, increasing each owner's stake in the underlying business. This is a classic move of a shareholder-oriented capital allocator. Then, they used the cash to acquire other businesses that possessed their own wide moats and had better growth prospects, such as television stations and, later, cable television systems. These were high-return businesses that could themselves generate more cash to be redeployed. They were using the profits from the old moat to acquire new moats. This strategy was transformative. It turned the Washington Post Company from a simple newspaper publisher into a diversified media conglomerate with a portfolio of superior assets. The stock price responded accordingly, increasing more than 100-fold over the following decades, creating fortunes for its long-term shareholders. This was not an accident. It was the direct result of a management team that understood its primary job was not just to run the business, but to intelligently allocate the capital it generated. The psychological principle that makes this test so vital is the principal-agent problem. This is the inherent conflict of interest that arises when one party, the agent in this case, a company's CEO and management team, is expected to act in the best interests of another party, the principal, the company's shareholders. In theory, a CEO's job is to maximize long-term value for the shareholders. In reality, the CEO's incentives are often very different. They may be driven by ego, a desire to build a larger empire, or a compensation structure that rewards short-term growth in revenue or earnings, even if that growth is unprofitable and destroys long-term value. This is why so many CEOs engage in value-destroying mergers and acquisitions. A big acquisition makes headlines. It increases the size of the company, and often the CEO's pay, and it satisfies a desire for action and expansion. The problem is that most acquisitions fail to create value for the acquiring company's shareholders. The CEO gets the thrill of the hunt and a bigger paycheck, while the shareholders are left with a weaker, less focused, and less profitable business. A rational shareholder-oriented CEO like Katharine Graham is a rare and precious commodity. They resist the institutional imperative to mindlessly expand. They are willing to be patient, to let cash build up on the balance sheet if there are no high-return investment opportunities available. They are willing to shrink the company by buying back stock if that is the most intelligent use of capital. They think like owners because, often, they are significant owners themselves. As an investor, your job is to find these rare gems. You must analyze a CEO's track record and public statements not as a fan, but as a skeptical business partner. Do they talk obsessively about creating shareholder value? Do they have a clear, rational framework for their capital allocation decisions? Is their own compensation tied to long-term metrics like return on invested capital, not just short-term earnings? Overcoming the principal agent problem by aligning yourself with managers who think and act like owners is one of the most powerful ways to ensure your portfolio benefits from the magic of intelligent capital allocation. This is a crucial piece of financial education for any serious entrepreneur or retail investor. To turn this analysis into a repeatable process, we can use a mental model called the shareholders' yield test. This framework forces you to evaluate a company's capital allocation policy from the perspective of a true owner. It has three components. First, analyze the company's dividend policy. A dividend is a direct return of capital to shareholders. Is the dividend consistent and growing? More importantly, is it sensible? A company in a fast-growing industry with many high-return reinvestment opportunities should probably be paying a small dividend or none at all, retaining its earnings to fund growth. A mature, slow-growing company with few internal investment options, like the See's Candies of the world, should be paying out a large portion of its earnings as dividends. A red flag is a company that pays a large dividend it can't afford, starving the core business of capital or taking on debt just to maintain the payout. Second, analyze the company's share buyback history. Buying back stock can be a wonderfully tax-efficient way to return capital to shareholders, but only if it's done at the right price. A management team that buys back huge amounts of its stock when the price is high and overvalued is destroying value. A management team that opportunistically repurchases shares when the stock is cheap and undervalued is creating immense value for the remaining shareholders. You must look at the history. At what prices did they buy back stock? Was it a smart use of the shareholders' money? Third, and most importantly, analyze the company's history of reinvestment and acquisitions. Look at the return on invested capital, ROIC metric, from our Moat dashboard. A company that can consistently reinvest its earnings at a high ROIC is the holy grail. If the company makes acquisitions, you must play detective. Go back and look at the major acquisitions from the last 5 to 10 years. Did they work out? Did they generate good returns? Or were they expensive failures that were later written down or divested? By running a company through the shareholders' yield test, analyzing its dividend, buyback, and reinvestment policies, you can get a very clear picture of the quality and rationality of its management. This is the final and most decisive step in any comprehensive stock analysis, the one that separates the truly exceptional long-term investments from the merely average. The antithesis of this disciplined capital allocator is the empire-building CEO. This is the executive who is consumed by the desire for growth at any cost. Their personal ambition and ego are tied to the sheer size of the company they run. They want to be on the cover of magazines, to be lauded as a visionary dealmaker. Maximizing long-term per-share value is a secondary concern. The empire-building CEO sees a pile of cash on the balance sheet not as the shareholders' money to be carefully stewarded, but as a war chest to be used for conquest. Their favorite activity is the large transformational acquisition, usually in a hot, sexy industry they know little about. They will almost always overpay, getting into a bidding war and justifying the exorbitant price with vague promises of synergies that rarely materialize. A classic example of this behavior was the disastrous merger of AOL and Time Warner in 2000. It was the ultimate empire-building move, combining the new media darling with a traditional media giant. The CEOs involved talked about creating an unstoppable, vertically integrated media powerhouse. The hype was off the charts, but the deal was a catastrophe born of hubris and a complete disregard for rational capital allocation. They paid an insane price for AOL at the absolute peak of the dot-com bubble, and the promised synergies were a fantasy. The cultures of the two companies clashed horribly, and the business models were fundamentally incompatible. The merger resulted in one of the largest write-downs in corporate history, destroying hundreds of billions of dollars in shareholder value. The empire-building CEOs who orchestrated the deal walked away with massive payouts, while the long-term shareholders of Time Warner were decimated. This is the danger you face when you invest in a company run by an executive focused on size and glory, rather than on per-share value. The shareholders' yield test is your shield against these value destroyers. It ensures you partner with prudent stewards of capital, not reckless empire builders. The direct financial connection between intelligent capital allocation and your portfolio is the ultimate driver of long-term returns. It is the multiplier effect on top of a great business. A company with a wide moat might be able to grow its earnings by 7% a year on its own. That's a good investment. But if that same company is run by a brilliant capital allocator who uses the cash generated by the business to consistently buy back shares at a 3% annual yield, by reducing the share count, the earnings per share will now grow at 10% per year. The investor's return will be dramatically higher, all because of the manager's skill in deploying capital. This is how the real magic of compounding happens. A great business is the engine, but intelligent capital allocation is the turbocharger. Think of it this way. The cash flow a business generates is an asset that belongs to you, the shareholder. Management's job is to invest that cash on your behalf. If they invest it at a 20% return, your wealth grows at 20%. If they invest it at a 5% return, your wealth grows at 5%. If they overpay for a dumb acquisition that generates no return, they have taken your cash and lit it on fire. The difference in your final portfolio value over a decade or two between a company run by a brilliant allocator and one run by an empire builder is not a few percentage points. It is often a difference of 5x, 10x, or even more. That is the power of this final principle. It is the capstone of the entire framework. Finding a business with a wide and widening moat is the first step. Confirming its strength with quantitative data is the second. But ensuring that the business is run by rational, shareholder-oriented capital allocators is the final, crucial step that transforms a good investment into a life-changing one. It is the key to identifying the true, enduring castles of capitalism that will stand the test of time and build your wealth for decades to come. You have made it to the end of this journey, and the time you have invested here is not trivial, but what you have acquired in return is something permanent. You now possess the lens of dynamic moat analysis, the mental model that separates the master investor from the crowd. You have moved beyond the dangerous illusion of the static moat, the idea that a company's past glory guarantees its future success. You have learned to identify the sources of a widening moat, the network effects, the switching costs, the growing brands, and the silent killers that cause them to narrow. You know how to quantify these dynamics using a dashboard of key metrics, and you understand the ultimate test of a great business, the skill and discipline of its capital allocation. This is no longer just a theory for you. It is a powerful, practical tool in your mental arsenal for building lasting wealth and achieving financial freedom. But here is the critical truth you must now confront. Warren Buffett's system, the entire intellectual architecture he and Charlie Munger have built over a lifetime, is not a collection of isolated tricks. It is a seamless, interlocking network of mental models. Mastering one is a monumental achievement, but it is still just one crucial piece of a much larger puzzle. Understanding the trajectory of a company's moat is absolutely essential. But a strong, widening moat is worthless if you pay a foolish price for it. An impregnable castle is a terrible investment if you pay 10 times what it's worth. Likewise, a brilliant capital allocator running a business with a deteriorating moat is simply managing a liquidation in the most efficient way possible. Each of these core principles must connect to the others to form a complete, cohesive investment philosophy. You have built one of the foundational pillars, but the bridge that connects it to the rest of the structure is still missing. The video that is now appearing on your screen is not a random suggestion. It is the next piece of that map. It is the link that connects the qualitative analysis of what to buy with the quantitative discipline of how much to pay. It explores the concepts of intrinsic value, margin of safety, and the temperament required to act when others are frozen by fear or drunk on euphoria. It is the essential next step in assembling the complete mental framework for long-term investing success. Without this next piece, your understanding of the moat is a powerful engine without a transmission. You have the horsepower, but you can't get it to the wheels. This next step is what connects your analysis of the business to the action you take in the stock market. This brings you to a decision. This is not about simply watching another video for entertainment. This is a deliberate choice about who you want to become as an investor and as a decision maker. Are you a tourist, casually collecting a few interesting ideas before moving on to the next shiny object? Or are you an architect, methodically and patiently building a complete and unshakable foundation of financial wisdom? The path of the 99% is to click away, satisfied with what they've already learned. The path of the elite, the path of the dedicated wealth builder, is to recognize that the journey is not over. It is to see the knowledge gap and be compelled to fill it. The choice is yours. Complete your mental arsenal. Continue your ascent. Click. And build the next pillar of your financial fortress.